How to track all mutual funds in one app. Many of the wealthiest people in the world owe their fortunes to different types of residual income, from stocks and bonds to investment trusts, real estate, commodities, and more. In this chapter we are going to discuss the importance of asset allocation, how you spread your assets into different types of products. When we talk about asset allocation, we refer to the various vehicles in which we invest our cash. We can split our assets into three specific classes: security, buy, hold, and speculative. It is advised that the largest chunk of your assets should fall into the security bucket, and this includes assets such as cash, ISAs, pension funds, home of residence, safe bonds, and government securities. These are the safest of assets. The next type of asset class is the buy and hold variety. These tend to be longer-term investments that are generally safe. Assets in this class include buy and hold stocks, mutual funds, and investment real estate. This type of asset is generally solid, with the stocks being of high pedigree with sound fundamentals that promise much for the future. The buy and hold chunk of your total assets should include approximately 15% of your entire assets. Finally, we come to the speculative class of assets. These are higher risk products that you jump in and out of quickly for short-term financial gains. These include stocks that you trade actively, IPOs, options, and futures warrants, and some of the more speculative mutual funds. Before you decide to enter into stock investment, it is worth drawing up a plan so that you can set your own rules about your asset allocation. Ultimately, the 70-15-15 rule to asset allocation will depend upon the individual investor, their risk tolerance, and their mindset. You can adjust the numbers to more closely match your attitude towards risk. Many experts believe that the asset allocation proportions should vary according to the investor's age. For example, those aged 40 or below may wish to employ a more aggressive strategy where only 40% of assets are in security and 30% are held each in buy, hold, and speculative investments. Again, your personal circumstances, preference to risk, and other influencing factors should be considered before arriving at your personal asset allocation numbers. You've heard the motto, if you fail to plan, you plan to fail. This applies as much to investments as it does to anything else in the world. How will you find suitable investments? Will you learn about them yourself, or will you seek out professional advice? How you will cope psychologically when your investments turn against you. The market moves heavily on psychology, and how you react to situations can be the difference between winning and losing. A more detailed plan should be created for each investment, outlining the reason for the investments as well as an entry and exit strategy. Remember, before you even look at an investment report, you must decide how your wealth will be allocated and then draw up a long-term investment plan that's right for you.